In the previous video, we learnt about money and money supply. Who supplies money in the economy? The institutions that supplied money in the economy were the Reserve Bank of India and the Government of India, as well as the commercial banks. So in this video, let us learn something about banking. The two financial institutions that deal with money are the central bank, that is the Reserve Bank of India or the RBI, and the commercial banks. The RBI or the central bank is the apex body which controls the other commercial banks. The Punjab National Bank, State Bank of India, Indian Overseas Bank, State Bank of Hyderabad, Union Bank, etc. are all called commercial banks which come under the same roof of RBI or the Reserve Bank of India, otherwise called the central bank. Each country has its own banking system and an apex body called the central bank. Now, what is a commercial bank? A commercial bank is that financial institution which accepts deposits from the people and offers loans for the purpose of consumption or investment. For accepting deposits, these deposits can be checkable or non-checkable. The checkable deposit is that against which checks can be issued and money can be withdrawn anytime. The non-checkable deposit is that against which checks cannot be issued and money cannot be withdrawn anytime. These deposits are for a fixed period of time called fixed deposits or term deposits. Advancing loans is the other function of commercial banks. Banks advance loans to producers for investment expenditure and consumers for consumption expenditure. Often loans are offered against some collateral or security offered by the borrowers of loan. When advancing loans, the banks charge some interest. The interest charged by commercial banks for the loans they offer is usually higher than the rate of interest paid by them for the deposits they accept. The difference between the two rates is called spread, which is the source of profit for the banks. So what is spread? Spread is the rate of interest charged by the banks for the loans they offer minus the rate of interest paid by the banks for the deposits they accept. This is called spread, and commercial banks generate their profits by way of spread. These functions of the commercial banking system are the basis of money creation or credit creation. Let's now learn how this money is created by the commercial banks. The total deposits with the bank is known as total cash reserve or demand deposits. A part of these demand deposits or the cash reserve is kept with the bank itself and the rest of the money is given on credit. This percentage or fraction of the money that is kept with the bank itself is called the LRR or legal reserve ratio, which is the minimum reserve that a bank must maintain as per RBI instruction. The amount that is given as credit is returned back to the banks, and hence the banks create money on the amount that is given as credit or loan to people or other institutions for investment. So the total credit creation will be equal to the initial deposits or the total cash reserve into 1 by LRR. So what is LRR? The LRR is fixed by the central bank and it has two components. The cash reserve ratio or CRR, which is to be kept with the Reserve Bank of India. And the second component is SLR or statutory liquidity ratio, which is to be kept with the banks themselves. So what is LRR? LRR is equal to CRR plus SLR. Say suppose the LRR is 20%, then SLR could be 12% and CRR could be 8%. So 12 plus 8 is equal to 20. Or else it could be 13% and 7%. So 13 plus 7 equal to 20. Let us see the two assumptions that we must look into before we learn credit creation. The two assumptions are that there is only a single banking system and that the loans that are taken are paid back to the bank. Let us assume that the initial deposits in the bank is rupees 10,000 and the LRR is equal to 20%. In the first round of deposits, we have 10,000 rupees. When the LRR is 20%, the 20% is kept with the bank itself and the rest is given as loans. So 10,000 minus 20% of 10,000 is 2,000, which is kept as reserve with the bank, and 8,000 rupees is given as loans. Now we assume that the loans are paid back. So this 8,000 rupees comes back to the bank as deposit. That is, the loan is returned. Of the 8,000 rupees, 20% of it is again kept with the bank, which happens to be 1,600 rupees. And the remaining, which is 6,400 rupees, is given as loans. Now this 6,400 rupees, which is given as loans, comes back to the bank, and in the third round, the bank has 6,400 in its account as deposits. 20% of 6,400 is 1,280, which is kept with the bank, and the remaining 5,120 is given as loans. The same happens in the next round, that is in the fourth round. 5,120 which comes back as deposits. 20% of it is kept with the bank and remaining 80% is given as loans. How long does this continue? This continues when the reserves equal the initial deposits, 10,000. So this becomes a secondary deposit which is equal to 50,000. The loans that have been paid will be equal to 40,000 and the reserves now equal the initial deposits or the primary deposit, which is equal to 10,000 rupees. So how do we calculate this? So total money that is created is given by what we learned just now, initial deposit into 1 by LRR. The LRR we saw is 20%. So 10,000 is the initial deposit into 1 by 20%, which is equal to rupees 50,000. That is what we get here as a secondary deposit. So when the bank gave loan for 10,000 rupees, it receives or it creates money worth 50,000 rupees. Here. This is called the money multiplier given by 1 by LRR. This shows an inverse relationship. This says as the LRR increases, the money multiplier decreases. When the LRR decreases, money multiplier increases. If it is 20%, it becomes 5 times. If it becomes 25%, then it reduces to just 4 times. LRR and money creation. So when LRR is 20%, the total credit goes 5 times. So the money multiplier is 5. When the LRR reduces to 10%, the total credit increases by 10 times. So the money multiplier is equal to 10. When the LRR increases to 50%, the total credit is only 2 times. So the money multiplier becomes 2. This shows that there is an inverse relationship between money multiplier and the legal reserve ratio. And the money multiplier is directly proportional to credit creation. So more the multiplier, more will be the credit. Less the multiplier, lesser will be the credit. So here 10,000 becomes 5 into 10,000. Here it becomes 10 into 10,000. Here it becomes 2 into 10,000. That is what we see over here. When the LRR is 10%, money multiplier is 10 times, and so it increases by 10 times. When the when the LRR increases to 20%, money multiplier is 5, and so it multiplies only 5 times. Whereas if the LRR increases to 50%, money multiplier is just 2, and so the initial deposits increase only by 2 times. Let's look into an example. Calculate the value of credit multiplier if LRR is 20%. Credit multiplier or money multiplier is equal to 1 by LRR. Since there is an inverse relationship, 1 by LRR, which is equal to 1 by 20%. This 20%, 100 goes up, 20 comes down, which is equal to 5. What is very important to note is LRR is equal to CRR plus SLR. If initial deposits is 5,000, then credit creation will be equal to money multiplier into initial deposits. So here we calculated money multiplier to be 5. So 5 into 5,000 initial deposits is equal to 25,000. Another problem, suppose, which you are going to try. Suppose initial deposit with bank is rupees 25,000 and LRR is equal to 20%. How much total money will be created in the economy? Try to solve this problem on the same lines to get this answer of 1,25,000. This is what explains the introduction of Jan Dhan Yojana by the government to increase money supply in the commercial banks, and also the impact of demonetization that brings in more money supply, more money into the hands of the public for consumption. So these are value-based questions, and it also shows how we are connected to the present economy of the country.